We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us today. We talk retirement. And certainly it's in the name, Decker Retirement Planning. That's the name of Brian's company. And of course, you can go to Decker Retirement Planning. Every week I say this. You can go to DeckerRetirementPlanning.com to find out more about Brian and the offices and where they are and all of that. But you can also go there under the heading of Safer Retirement Education. There's about a dozen things you can download, including Brian's book on retirement, the Decker Approach book. There's 12 different things to download. It's really, there's no cost to do so. It's just there for your information. You want to learn a little bit more about different areas of retirement. It's a great resource for you. So DeckerRetirementPlanning.com under the heading of Safer Retirement Education. And then if you have questions, boy, should I be moving money into the Roth world? My 401k IRA, should I move some of that to the tax-free side where I pay taxes now, and then that all grows tax-free from there on? It's great for some. It's not great for all. So Brian and the team at Decker Retirement are here to help you figure out where's your income going to come from in retirement. What about the investment side of things? What about the tax side of things? Healthcare, legacy, Social Security, Medicare. A lot of decisions as a retiree. 833-707-3030 is the number. 833-707-3030. You got questions, you got concerns. Call the team and have a conversation. There's no cost to you whatsoever. 833-707-3030. We're going to get into year-end planning and those kind of things that you should be doing before 2024 wraps up and we head into 2025. But first, we're going to talk about the election. This is going to be a big political statement today. No, wait, that's not what we're going to do, is it? We are going to talk about the fact, though, that Trump is now the president-elect, and it affects things tax-wise, the market-wise. I guess your thoughts. At the end of the day, I tell my friends that think differently than I do that it doesn't matter. I've been alive with Republican presidents, with Democratic presidents. At the end of the day, Brian, I want to play golf this weekend. I don't really care who's in office. But part of the thing that you have to deal with is who is in office. There are things in Washington and Wall Street that do control the things you do for your retirees at Decker Retirement. So it's not in support of whoever's in there. You just have to take notice of who's in and what things we should be thinking about when the president changes, right?
Right. In fact, Mark, you know these statistics. Going back to 1920, look at the years when Democrats had the White House and both houses of Congress. There were, I think, 38 years of that happening. The average rate of return during those years was 12.35%, 12.35. There were 16 years where Republicans had the White House and both houses of Congress. Average annual return is 12.35. I'm not making this up. Exactly the same, exactly to the 100th decimal point. I just think that on the investment side, historically at least, maybe in the future it'll change, but historically it hasn't mattered. And then when you have combinations of Democrats going to the White House and then the Republicans in both houses of Congress, you have these different combinations. They're very, very close. The difference between Democrats and Republicans favoring one in the House, one in White House, or owning both houses of Congress, those combinations, the rate of return over that period of time is very, very close. So when it comes, again, historically, maybe in the future that will change. Maybe this time it will be different. By the way, that's the most poisonous, toxic words on the investment side is this time it's different. Just note that. But anyhow, historically, there hasn't been a difference, but we want to be sensitive. Half the country is devastated. Half the country is elated. So we're just going to stick to on the investment side. So on the investment side, you have green energy investments that are not doing too well because Democrats lost the White House. You have the energy trades. You have so-called Trump trades that's doing well in sectors like industrial, manufacturing with onshoring, banking, defense, energy. It's also propelled stocks like Tesla with the involvement of Elon Musk in the White House and him playing a big role in Trump's cabinet, in his future cabinet. Trump Media, DJT. Equity futures are also up huge. Dow Jones up more than 1,200 points day after. Bitcoin breaching 80,000. The S&P and the markets are clearly getting ahead of themselves. Another seasonality trade, looking at the follow through, it looks like typically markets have follow through on this momentum into and through March, and then markets start to back off. So at least going forward, what do we recommend for investors who are retired to do? Now, in retirement, we believe we're true fiduciaries to our clients. We're a math-based firm. We do a lot of research. We have a 6-figure research budget. We've done our homework. Mark, tell me if this makes common sense to you. In your 20s, 30s, 40s, 50s, you buy and hold the S&P, the indexes, because of two reasons. If the markets drop 30 or 40%, reason number one is every 2 weeks you're kicking new money into your 401k. So you're dollar cost averaging into a down market. And number two, you've got the time, you've got the 3 to 5 years for the markets to recover. So you can do that, and your income is coming from work. When you're over 65 and you're retired and your income is coming from a portfolio that's down 30, 40, 50%, that's an entirely different situation. So what we recommend clients do, at least on the investment side, is use what are called momentum strategies. We've done our research on this. Momentum, since 1950, the biggest study ever done on this was by Jake O'Shaughnessy in his book, What Works on Wall Street, page 367, Appendix A. Since 1950, what strategies have produced the highest returns in the stock market, period? Not the top 1, 2, or 3, but the top 15 are all momentum strategies, relative strength and sector rotation. It's all the same. So Mark, imagine every stock is ranked 0 to 100 based on relative strength, which is price appreciation and volume. And momentum has you buying the top relative strength stocks, and when something better comes along, you rotate into it. It is sector rotation, it is momentum, it is relative strength. So, for example, First Solar, a green energy investment, has gone down very quickly since Kamala lost the election. And other stocks, the Trump trade stocks, have rotated into favor. Momentum has you buying what is going up the fastest. So for example, in 2000, 01, and 02, the S&P is down 50%, NASDAQ's down 70%. A lot of people lost a boatload of money in those 3 years. During those 3 years, momentum had you investing in stocks that were making money all 3 years. Real estate through the REITs, gold, silver, energy, pharmaceutical, biotech, healthcare, pharmaceuticals, all those made double-digit returns each year for 3 years. And when the markets bottomed in March of 03, what exploded to the upside for 4.5 years was technology, semiconductors, small caps, emerging markets. They exploded for 4.5 years. Then wrote into 2008, that was a waterfall decline. Momentum stops you into cash because nothing is going up except for treasury bonds. So you own treasury bonds. Those were up over 20% in 08. That's how momentum works. So going forward, is there going to be sector rotation? Absolutely. You can count on it. Are there going to be different markets to invest in? Absolutely. Different sectors, different stocks. You and I can't possibly know what the winners are going to be next year or the year after. Can't possibly know that. So that's why we use momentum. It produces the highest returns. It is the most consistent performer. And what we did here at Decker is we split it so that Just like in the NFL, we have an offense and a defense. When the S&P is trading above the 200-day moving average, by definition, the market is in an uptrend. And so we use an offensive team. We have 6 strategies that are equally allocated in markets that are going up. We cherry pick what is going up the fastest. We cherry pick the best parts of the market. Then when the market crosses the 200-day move, which you have a downtrend in place, offensive team comes off the field, the defensive team comes on the field, and those are handpicked 4 different managers that are momentum focused, very sensitive to buying whatever is going up in a down market. So we've designed these risk models so that we don't have to know what the best investments are going forward. We have algorithms that automatically pick that up. We have an offensive team making money when markets go up. We have a defensive team that's designed to make money as markets go down. So,
but I would say this, you don't have your clients at Decker Retirement Planning, the ones that are retired and they've got enough money, they don't need more, they've already won the game. They might have 25% of their portfolio in stocks because the other 75% is safe and protected. I mean, it depends on where we are, whether we still need a lot of growth to survive in retirement or we don't. I mean, the strategies reflect the situation of the clients of Decker Retirement, don't they?
Well, yes, that's another big thing is quantitatively we reduce client risk. We think it's insanity to have 60 or 70% of their nest egg of all that they've made in their adult life and their career in the stock market with risk exposure. Our clients have much less exposure to risk at 25%. So we reduce client risk 3 ways: quantitatively from 60 or 70% down to 25%, and strategically by using momentum managers that are able to and designed to make money in up or down markets. And we eliminate interest rate risk because we don't believe it makes any sense to buy bond funds when interest rates are going higher. It's interesting, Mark, that interest rates in the open market have gone up since the Fed has lowered rates. The open market rate has gone higher.
Yeah, that seems different to me. Also, though, you think about it, I mean, at the end of the day, it doesn't matter who's in charge, in the White House, in the Senate, in the House. I mean, those things change an awful lot. Every 2 years, there's a House election. You got the senators that are every 6 years, the White House every 4 years. I mean, so there's always change. And it, to me, would make no sense if you said, every 2 years, Brian, you got to blow up my portfolio and let's start again. There are parts of it that maybe 5 to 10 to 20% maybe that we adjust, but it's not the whole thing. That would be fair to say, right?
Correct. And so what we have in our portfolios for retirement planning, by the way, accumulation strategies are what you have in your 20s, 30s, 40s, and 50s. And the people in banks and brokerage firms are very good at that. They're honest, hardworking, ethical people. But once you're retired or within 5 years of retirement, you've got to switch to a distribution plan. So when I had my knee replacement, I didn't go to dentist. A dentist is a good person, work hard, ethical, but I needed an orthopedic surgeon to do what I needed to do. We are specialists in retirement planning. That is all we do, is planning for retirement for our clients. So Mark, to your point, in a portfolio that's for retirement, we have laddered principal guaranteed accounts for 75% of their client portfolio. We have bucket 1, which is a cash account at Fidelity earning 4.65%. We have buckets 2 and 3 that are 3 and 5 year CDs. They're locked in. So buckets 1, 2, and 3 make money no matter what the markets are. In 2022, S&P down 19, Nas down 33, bonds down 20%. A lot of people took a pounding. Our clients made money in buckets 1, 2, and 3. Buckets 4 and 5 are 7 and 10 year principal guaranteed accounts with average annual returns twice of what the CD rate is. Twice. They cannot lose money. They didn't lose money in 2022. And then we have the risk bucket, which is about 25% of their money. That money is to grow and in 15 to 20 years, replace what they started with. If a client starts with 1.5 million in retirement at age 65, We peel off 25% so that that money grows in 15 to 20 years and replaces that starting balance, because that 75% is paid out to them plus interest over the next 15 to 20 years. That is called distribution planning. 75% of their money has no risk. When you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. Pulling money from a pie chart is pulling money from a fluctuating account, and it works until it doesn't, and eventually it won't work. That's what happened in 2008 when millions of people in 2009 had to re-enter the workforce. Our clients will never have that happen because they're pulling money from laddered principal guaranteed accounts.
So at the end of the day, it's really about you. You come in and sit down with the team at Decker Retirement Planning. How can they help? Do you have questions about income, investment, taxes, healthcare, legacy planning, Social Security and Medicare decisions? It's all part of retirement, but Washington and Wall Street do have a piece of your retirement. You have a 401k or an IRA, 20 to 30% of it's Uncle Sam's, right? So there are factors in there, but at the end of the day, it's about you. How can Brian and the team help? All you have to do is give them a call. There's no cost, 833-707-3030, totally complimentary. Might be one of the more important phone calls you make, I think. If nothing else, just to get clarity into where you are, 833-707-3030. We're going to come back, talk more with Brian J. Decker of Decker Retirement. We're going to talk about year-end strategies as well as the 2017 Tax Cuts and Jobs Act. Will it continue, like Trump has said? Back with more right after this.
Just as the seasons come and go, so too do the markets ebb and flow. If market volatility is making you nervous, give Brian a call and make sure you're not taking on more risk than you're comfortable with. 833-707-3030. That's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott, 833-707-3030. If you need a little insight into where you are on that road to retirement, are you invested the right way? Are you taking too much risk, not enough risk? Everybody's situation is unique. And that's how Brian and the team, there's not one plan at Decker Retirement for all the clients. Every plan is built for that individual, that couple, that family. It's all about you at Decker Retirement. They're here to help if they can. They don't know if they can until you reach out. 833-707-3030. I'm Mark Elliott. Glad you're with us. We're talking a little bit about the election. We're going to get into year-end planning, right? We're coming to the end of 2024. What are some of the things you should do before the calendar flips to 2025? I did want to talk about this as well. And like Brian said, Brian said half the country is happy, half the country is depressed. I would say 20% of the left is super depressed, 20% of the right is super elated. The rest of us, the 60% of us are like, yeah, whatever happened, we're going to keep going to work the next day. And I was hoping to play golf on the weekend regardless of what happened. So at the end of the day, it's just us continuing our lives. We've all been alive when Republicans are in charge and then Democrats have been in charge. At the end of the day, it's about us and our family and how can we, help our kids be better off than we were and all of that. But that being said, one of the big things in the election was that Kamala Harris said, okay, the 2017 Tax Cuts and Jobs Act, we're going to make sure it ends at the end of 2025 because that's how it was set up in 2017. Trump has said, I'm going to continue that. Now, he can't do that himself. It's Congress that makes that decision. But that's kind of a big deal because you're talking a lot of times to your clients, Brian, about conversions, taking the 401k or the IRA that's on the traditional side, pay taxes now where taxes are low, and then the grows tax free, but you do have to pay taxes to convert it. Does this buy you a little bit more time in doing those conversions, maybe?
You don't know what's going to happen. To your point, Mark, it's Congress that has to decide whether to roll forward the Trump tax cuts. So we don't know if they're going to. So what we do is work with what we do know, and that is uncertainty from January 1, 2026. If the Trump tax cuts do sunset, most tax brackets go up about 3%. So if you're in the 24% bracket, it's 27, 22 becomes 25, et cetera. And so we want to work with what we know. We want to take advantage of Roth conversions this year. We want to take care of Roth conversions next year in 2025. We don't know what's going to happen in 2026. So as we get closer to 2026, we'll have more certainty, but we're going to go with what we do know. But on this topic of Roth conversions, you have a deadline not of April 15th of next year. It is 12/31. If you don't convert from IRA to Roth by the end of the year, it's going to be a 2025 transaction. It's going to affect taxes in 2025. So this is something that you need to get in order and do it right. So let me start from the top on the value of a Roth conversion. Let me give you some numbers on this. Let's say that there was, instead of let's say, we actually have the numbers in front of me right now. 60-year-old with $1 million IRA growing at 6% a year. At age 73, dutifully, they pay their required minimum distributions. And then we killed him off at age 90. How much tax did he pay? Well, in his lifetime, he paid $676,732.22. But wait, there's more. The beneficiaries of that IRA, according to the Secure Act passed by Congress 5 years ago, they pay another $718,496.14. Total of $1,395,228, almost $1.4 million. Mark, here is where it is a sickening number to see that a net of tax transfer of $1 million IRA growing at 6% for 30 years, the net of tax transfer is $1,223,385. $1.2 million is all. The IRS got almost 1.4 more than what the beneficiaries got. The IRA is the most tax inefficient vehicle on the planet. It is horrible. So what we want to do is do Roth conversions. So what would the numbers look like if we did Roth conversions? Same 60-year-old $1 million IRA growing at 6% a year. We aggressively do Roth conversions, 225, 225, 225, and then 50,000 a year, so that by age 73, required minimum distribution age, there is nothing left in the IRA. We killed him off at age 90. How much tax did he pay? Did he pay $1.4 million? No, paid $319,474.93, a savings of almost $1.1 million. Did he transfer 1.2 to his children? No, transferred 4.1, $4,151,932. Huge difference. The Roth conversion is where you pay taxes now because you believe that tax rates in the future are going to go higher. There's 35 trillion reasons why tax rates in the future will probably go higher. If you believe that, you wisely, proactively pay taxes now, so all of that growth is tax-free. The income you draw from that is tax-free, and the asset that you pass to your beneficiaries is tax-free. The Roth is singularly the highest, most best tax strategy for most people in the United States, retirees. So there's a right and wrong way to do a Roth conversion. Do we do Roth conversions on cash? No. 3-year, 5-year CDs? No. 7 and 10-year principal guaranteed growth accounts? No. those accounts' growth rates are too low and we're taking the money too soon. It's only the risk bucket money that we do Roth conversions on. So how do we do it? We go to the gross income of the client. We take out their standard deduction as a single or a married filing jointly filer to get the AGI adjusted gross income. And then we look at the tax tables for 2024 to figure out how much we can do to keep them in the same tax bracket. We call that headroom. How much can we convert to keep you in the same bracket, whether it's 12, 24, 12, 22, or 24? Now, we want to try to keep clients out of the 32% bracket if possible. It is a first world problem, but if you're in the 32% bracket, the break even on the taxes owed might push you out from 2 years to 3 years. So we just talked to a client right before the radio show. He's in the 32% bracket. He still agreed to do it because in 3 years, he will have made up his taxes and then all that growth is tax-free. We don't have time to hit these other points, but we are going to cover on the other side of the break tax loss harvesting, where by year end, you want to make sure that you look at your non-qualified portfolio and you raise your cost basis on your winning stocks and you take your losers out. We'll talk in detail about that. We'll talk about charitable giving. We'll talk about required minimum distributions, how to properly take them, and how most people don't take them properly. But we're going to cover all of those on the other side of the break. Those all have a 12/31 deadline. These are not April 15 deadlines. These are 12/31 year-end deadlines.
So we got a lot to get to still. We've covered a lot of ground already. And you think about the Roth conversions. Okay, do I want to pay, if I had $1 million at 60, do I want to pay 4.4 million in taxes? Or no, 1.4 million in taxes? Or would I rather pay 300,000? Well, everybody's situation is unique. Not everybody should do Roth conversions. And that's one of the key things. Don't think Brian right now is telling you, hey, go out and liquidate all of your IRA and 401k money and put it into the Roth and pay taxes now. There's a strategy involved if it makes sense for you. That's why you talk to the team at Decker Retirement. 833-707-3030 is the number. Again, no cost to you, no obligation, no pressure, no judgment either. They're here to say, hey, here's your situation, here's what we think. And at the end of the day, it's your decision. It's your retirement. It's your money. 833-707-3030. Might be one of the most important phone calls you make. 833-707-3030. Back with more of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030. to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Ellie. Glad you're with us. Again, you can go to the website to learn more, deckerretirementplanning.com. And on that website, under the heading of Safer Retirement Education, there's a dozen things you can download. And it's information just for you, just to learn more about the financial world, the retirement world. A great place to start is just download Brian's book on retirement, the Decker Approach Book. Give you a great insight, I think, into retirement. You can do all of that on the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. There's no cost to you. Download any or download all of it. It's up to you. It's just there for your information. We're talking about taxes, and the 2017 Tax Cuts and Jobs Act that Trump put into play in 2018, it expires at the end of 2025. Right now, Trump has said he's going to extend it, but we know it's not his decision. It's Congress that makes that decision. So maybe we only have 1 year of lower taxes. We're almost $36 trillion in debt as a nation, so we all feel taxes will go up. Trump says he's going to continue that. We'll see, right? We don't know for sure. 2026, if we don't extend that 2017 Tax Cuts and Jobs Act, we're going to go back to 17 rates and brackets. Basically, our taxes go up by 20 to 30%. So there's a lot hinging on all of this, but Brian was just talking about Roth conversions, and it's not willy-nilly, right, Brian? It's not everybody should do Roth conversions. It makes sense to sit down with a team like yours at Decker Retirement to make that decision, doesn't it?
Right. We have some clients that come in and they've already done the hard work. They have enough Roth conversions done for their portfolio. So we're a math-based firm. We're fiduciaries to our clients. We know to the dollar how much money of Roth should be in a client portfolio. Again, it should not be in their cash accounts, their 3, 5, 7, or 10-year principal guaranteed accounts, because the growth rates are too low and you're taking the money too soon. So it has to be done, should be done correctly by keeping you in the same tax bracket, ideally, and trying very hard to keep you out of the 32% bracket if possible.
So again, that's where Brian and the team can come in and help you understand your situation better. Hey, maybe you should take $5,000 and roll it into the Roth world, pay the taxes now. Maybe you should take $50,000. I don't know. Maybe you shouldn't do it at all. That's where Brian and the team really come in to help guide you. I think it's so important. Unless you've worked in the retirement planning world all your life, you would understand this. I haven't. I don't understand that. I'm thinking about, man, I hope I can make that birdie putt. That's a key factor for me, not this money stuff. I need somebody to help guide me. And Brian and the team at Decker Retirement certainly are here for you. 833-707-3030. All right, you were talking about there's a lot of things that we have to do by the end of the year, and it's the same every year. There's different things we have to take care of. But December 31st of 2024, we have to make sure that we have done some of these tax things because they don't carry over in just to get them done before tax season in April. You've got to do them by the end of the year. You've got a list of things we need to think about.
Yeah, we covered Roth conversions already in the last segment. So let's talk about tax loss harvesting. So, Mark, let's say that your portfolio has Apple, has Amazon, has Microsoft, and those are your 3 big winners. But you've got a bunch of dogs, and this is in a non-qualified portfolio. What that means is a non-retirement account, not an IRA, not a Roth, not a SEP, not a 401k. Those are all retirement accounts where all that growth is tax deferred. We're talking about in your non-qualified, in your individual account, in your joint account, in your trust account. Those are all non-qualified taxable accounts. A lot of people have held Amazon, Apple, Microsoft for years, in some cases decades, and they've got huge gains on those. What should happen at the end of each year? Well, at the end of each year, you look at your dogs. If you have losses that you're carrying forward each year, take a look and ask your CPA, how much in loss carry forwards do I have? Mark, I'm just going to make this up. Let's say you have 25,000 in loss carry forwards. Well, then we're going to look at your portfolio. Well, Mark, you bought that XYZ stock that your friend told you about on the golf course, said it was a no-brainer, and they were coming out with brand new pharmaceuticals that for sure were going to get passed by the FDA. Guess what happened? It went from 25 to 5, and you have another loss there of 25,000. And oh, by the way, you bought First Solar thinking that Kamala was going to get elected, and you're down 25,000 on that one too. So what do you do going into the end of the year? Well, you have a total of 75,000 in losses. Here's how this works. And by the way, this is complicated, so you may want to go to the website and pull up and replay under Safer Retirement Radio. You can replay this segment and write these notes down. This is worth doing at the end of the year, every year in fourth quarter. You look at your loss carry forwards, number 1, you look at your losers, number 2, and total them up. So you got 75,000 in losses. So what you do is you take one of your winners, let's say Microsoft or Amazon or Apple, and you sell 75,000 worth of, and I'll just make this up, Apple stock. Then you have to stay out of it for 31 days. So you wait 31 days and then you rebuy it after 31 days. So what do you do if Apple stock goes up in those 31 days? Well, you put that 75,000 that you sold of Apple stock into the QQQ, the NASDAQ index, because if Apple is going up, chances are the NASDAQ is going up. It gives you a surrogate for that 31 days that you're out. Now, what do you do on the loss side? On the loss side, you sell your losers, but let's say that you believe in your losers still. So you have 25,000 in loss carry forwards that you've used, and you've got XYZ pharmaceutical I told you about from your golf buddy, Mark, and you've got another 25,000 in First Solar that you're down. So you sell your XYZ pharmaceutical, you sell your First Solar, and those two stocks, let's say, and again, I'm making this up, you don't want to buy, let's say that you do want to buy XYZ. So what is your risk of being out of the market on pharmaceuticals for 31 days? Well, you'd buy the biotech ETF so that would be your surrogate for 31 days. And then on First Solar, you would buy the clean energy ETF for those 31 days. So you've got placeholders in place. And then after 31 days, you repurchase the Apple stock, and then you have a higher cost basis by $75,000. Now, if you keep doing this every year, you will be raising your cost basis, lowering your capital gains exposure. This is called tax loss harvesting. If you have a banker or broker and he or she is not doing this, they should be. If you're not getting your money's worth, if they are not helping you with this every year in the fourth quarter. So that is how it's done. And again, at the end of that 31 days, you rebuy Apple, you rebuy XYZ pharmaceutical, you rebuy First Solar. You've got all the pieces back in place that you want. If they're dogs and you don't want to repurchase, you can put more money in your winners, whether that's Microsoft, Apple, Google, whatever it is. But that is how tax loss selling is done at the end of each year. And again, that should be part of the services that you get from your banker, broker, advisor. And that's got a 12/31 deadline, just like the Roth conversions. Now let's talk about RMDs, required minimum distributions. You've made tons of money in your IRA. Now the IRS wants theirs, and they want a minimum of about 4% per year, and it goes up for the rest of your life. This is how they get paid. They are a partner in all of your gains, all of your life. Now, depends on when you were born. Some people have required minimum distributions starting at age 72, some of them at age 73. It depends on when you were born. You can look that up. You can Google and look at, based on when you were born, when your required minimum distributions are due. But what you look at is, as of 12/31 last year, what was the value of all of your IRAs, not your Roth, but IRAs include any SEP IRAs. It includes all of your IRAs, not Roth, not 401k. And you look at your divisor that is given on the required minimum distribution site for the government, and that helps you take that. Let's say there's 1.3 million in IRA. You divide that by your divisor, and that gives you a dollar amount, a required minimum. You could take more, but that's the minimum that you need to draw. Our clients have the benefit of having us in charge. We make sure that our clients each year have their RMDs paid out. And if they don't, and if they get penalized, we pay that penalty. We take care of our clients. We're on top of it. Now, there's a right and wrong way to take required minimum distributions. The right way is to have that be part of your income anyhow. You want to be drawing down on your IRAs before. There's 35 trillion reasons, again, that we expect tax rates to go higher. So proactively, you want to be drawing on your IRAs before tax rates go down, and so that your exposure at age 72 or 73 is less. You want to minimize your exposure to your required minimum distributions. Part of your RMD, all of it, in fact, for our clients, comes out as income in that year. That's the right way to do it. Pay it out as income. The wrong way to do it is to take income for the year and then at the end of the year have this big wad of RMD come out. That is unnecessary because it bumps your tax rate up. And so that's the wrong way to do it. The right way to do it is to take it out as an income stream during the year. So that has a year-end deadline of 12/31. That's not an April 15th deadline. Tax loss harvesting, Roth conversions, required minimum distributions all have a 12/31 year-end deadline. Now, charitable giving is the other one with a 12/31 deadline. If you give to your church or any charities, 501c3s, the good news is you've done a good thing. The bad news is with the standard deduction being so high as part of the Tax Act, write-offs are really tough to come by. Where it benefits you is with a donor advised fund. So a donor advised fund is an offset to a spike in income. Let's say, Mark, that you are on the pro tour and you win $3 or $4 million this year. Your last 10 years winnings were, let's say, 250,000. But this year you got hot and you made $3.5 million. And the next 10 years, let's say you settle down into 250,000. So what do you do with that spike in income this year? Well, you can use a donor advised fund. That takes 5 years of charitable giving and concentrates it into 1 year as an offset write-off to that spike in income. Clients use it a lot for spike in incomes from exercising stock options. But those are the things with a year-end deadline of 12/31, tax loss harvesting, Roth conversions, required minimum distributions, and charitable giving.
So again, if you want to talk to Brian about any or all of this, really it's about you. How can Brian and the team at Decker Retirement help you move forward with retirement? Make sure that your money will last as long as you need it to. 833-707-3030 is the number. Again, no cost, totally complimentary to you. It could be one of the more important phone calls you make, I think, because it can give you insight and clarity into your retirement picture. 833-707-3030 again is the number. 833-707-3030. All right, so what are some other things we need to think about as we run into the end of another year? Brian will talk about that when we come back right here on Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning.
The holidays often remind us how expensive life can be. If you're feeling a bit more financially squeezed this season and worry about how you'll fare in retirement, give Brian a call at 833-707-3030. That's 833-707-3030.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, the website, DeckerRetirementPlanning.com. Questions, concerns, give the team a call, no cost. 833-707-3030, 833-707-3030. I'm Mark Elliott. We've been talking about the things you need to do before the end of a year, right? December 31st of 2024. What are the things you need to do? Tax loss harvesting, Roth conversions, required minimum distributions. Charitable giving is an opportunity for you, but all has to be done before the end of the calendar year. There are other things that we need to consider and think about as we run into the end of another calendar year. What are some of those?
Well, we've got to review the investment portfolio and make sure that it represents what you want to have going forward with this new administration. You want to check your insurance coverage. We'll talk about that. We want to update your estate documents, your will, power of attorney, living will, and trust. You want to consider whether or not you should have long-term care, or if you do you have enough? Take a look at all those things. So it's kind of a spring cleaning at year end. So let's start at the top, reviewing your investment portfolio. Again, I mentioned in the first segment, momentum strategies take the guesswork out of investing on the risk side, on the stock side. By the way, momentum strategies also are important for another reason I didn't mention in the top of the hour or the first segment, and that is there's been 4 times the stock market has changed, and there's been 4 times that the S&P 500 has traded above a market valuation of 30 times trailing earnings. That's only happened 4 times. One was 1929. Markets were flat for 17 years. The second time, 1964, markets were flat for 18 years. The third time was November of 1999. Markets were flat for 14 years. The fourth time was November of 2021. We hit 32 times trailing earnings. Please pay attention to what I'm going to say. With 100% of history vouching for what's ahead, that means that the next 10 to 15 years in the stock market are 2 steps forward, 2 steps back for 10 to 15 years. That means that any passive buy and hold investment portfolio, buying and holding stocks, mutual funds, indexes, or ETFs will yield a 0 return for the next 10 to 15 years. That's devastating for people in retirement. It's another reason why we use momentum strategies. Momentum strategies is where you rank all the stocks based on relative strength 0 to 100. Momentum has you buying the top relative strength stocks, which is a function of price appreciation and volume. And when something better comes along, you rotate into it. It is sector rotation. It is momentum. It is relative strength investing. That strategy has produced the highest returns of all stock strategies since 1950 in the study done by Jake O'Shaughnessy in his book, What Works on Wall Street. So if we have a flat market cycle in the next 10 to 15 years, what we plan on doing at Decker Retirement Planning is we have an offense and a defensive strategy. When markets are trading in an uptrend, trading above the 200-day moving average of the S&P, we are cherry picking the best parts of the market and investing in those based on pure momentum. What is going up the fastest? Then when the markets start a downtrend, when they cross the 200-day moving average, markets started a downtrend. Just like in the NFL, we have the offensive team come off the field. We have the defensive team come on the field. Those are different momentum strategies handpicked because of their sensitivity to buying whatever is going up in a down market, allowing our clients to make money in a flat market cycle as markets go up and as markets go down. This is devastating for people that have buy and hold passive investment strategies. At year end, now's the time to review your investment portfolio. Do you have a 60-40 portfolio? We think that's insane. To have 60 or 70% of your portfolio in the stock market with stock market risk and exposure going into a flat market cycle. That, to us, is insanity. Do you have bond funds? Why do you have bond funds in a rising interest rate environment? Bond funds lose money as interest rates go higher. We would not recommend that you have bond funds. Those have lost over 30% in the last 4 years. And bankers and brokers, advisors call that safe money. It's not safe. It is financial malpractice, in our opinion, to hold bond funds in a rising interest rate environment. So look at your portfolio. Call us, get on the schedule. We can help you. Do you have a laddered portfolio of principal guaranteed accounts with 75% of your portfolio? That's what we think you should have. By year end, keep what is working, make changes to what isn't working. But a laddered portfolio for us has a cash account for the first 5 years of funds in bucket 1. Then we have a 3-year and a 5-year CDs in place for buckets 2 and 3. Then we have a 7 and 10-year principal guaranteed accounts in buckets 4 and 5. Those are equity indexed accounts that have averaged 2 times the CD return. And then we have your risk bucket, which grows for 15 to 20 years and replaces or replenishes what you've spent. That to us that's a distribution plan that works in retirement. A pie chart. Mark, how would you feel if you had a pie chart, a fluctuating account going into a flat market cycle with something called the Monte Carlo simulation telling that you've got an 86% chance of succeeding in retirement? How would that make you feel?
That's better than 0% chance, but I would prefer a little higher percentage. I don't want to get on a plane that's got an 86% chance of making it to its destination.
Right. And so we use laddered principal guaranteed accounts that when you draw from those in 2022, for example, S&P's down 19, Nas down 33, bonds down 20, commodities across the board were down. People got hammered in 2022. Our clients were one of the few that made money in 2022. We made money because we're drawing income from laddered principal guaranteed accounts. There's a math-based principle that when you draw income from fluctuating accounts, you compromise gains when markets go up, you accentuate losses when markets go down, and eventually that's going to send you back to work. We don't do that. So our clients have tremendous peace of mind with a distribution planning portfolio. But by year end, spring cleaning in Q4, you want to go through your investment portfolio to make sure it's what you want with this new administration and for 2025. The next thing, check your insurance coverage. Is it where you want it to be? Now, when it comes to insurance, we say that life insurance is to get you to retirement. If you have it, keep it. If you don't need it once you're retired, unless there's a situation that we want to protect loss of income. So for example, let's say, Mark, you're married to Jane. Jane has a $100,000 pension that dies with her. Well, Mark, you're vulnerable, and we would want to have a $100,000 term life policy, or ideally whole life policy, if it's not too expensive, in place to protect you from that loss of income. I would say maybe 5 to 7% of our clients have that situation, so it doesn't come around a bunch, but that's something that we want to have insurance for loss of income. We want to make sure that that risk exposure is taken care of. But on insurance, life insurance, that's something that we look at. We want to make sure that the insurance coverage is in place. But there's another kind of coverage that is something that's very, very important. It's called an umbrella liability coverage. You can buy $1 million liability coverage, no questions asked. It's a rider on your homeowner's insurance. You can't go out and get it anywhere. Whoever has your homeowner's insurance offers it. It's $1 million, and it protects you, no questions asked. So here's what you're being protected from: scams and this is becoming a cottage industry. Imagine that you're driving up to a stoplight and you've got two people at the stoplight. One guy has walked up 20 paces, and while you're slowing down, he throws himself across the hood of your car, and then you slam on the brakes. He rolls on the ground, writhing in pain. Two witnesses say that you hit him, and he's got soft tissue injuries, and he's demanding $400,000. You hire an attorney. He says you have no chance because of those two witnesses. Now you're out $400,000. Umbrella policies cost you $300 a year. So this is something that if you don't have coverage, it's devastating to take a $400,000 hit. Would your car insurance pay the claim if you were at fault on that liability? Sometimes. Those big office buildings were created by denying claims, not paying claims. So we want to make sure that you have in place the no questions asked umbrella policy for liability.
So a lot of things obviously need to get done before the end of the year. And the team at Decker Retirement Planning here to help you. Just give them a call at 833-707-3030. Tax loss harvesting, Roth conversions, required minimum distributions, charitable giving. Review your investment portfolio. Brian and the team can certainly help you with that. Check your insurance coverages. What about legacy and estate plans, health care, long-term care? There's a lot going on. The team at Decker Retirement here to walk you through your situation. How can they help? They don't know until you reach out. They'd love to sit down with you, though, and have a conversation to see if they could bring some, information to you. Hey, you've already won the game. Now you need to do a little bit more. No, you're good to go. Hey, you got retired 5 years ago. Be nice to find out. 833-707-3030. Again, totally complimentary. 833-707-3030. Brian, as always, enjoyed it. Enjoy the rest of your weekend. We'll do it again next week.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.